Hello dear student, I am Najmus sahar, lecturer in business studies, Vishwamana College Chitradurga. So dear students, in last videos we have discussed about the concept of financial markets. As you know that financial market, there are two terms, finance and the market. This we have discussed in a last videos itself. Financial market is a market for the creation and exchange of financial assets and other derivatives for the values. Okay, that detailedly the meaning of financial markets we have discussed in a last video itself. In again the classification of financial market also we have discussed. Okay, in that classification we have money market as well as the capital market. Again, in the capital market we have subdivisions like primary market and secondary market that we have seen in last videos. Today I am going to explain the primary market, how the company's method, which are the methods the company is going to follow to raise the capitals from the market. Okay, so that is what we say, flotation of new issues are methods of flotation, how they are going to raise the capital from the primary market. As you know that primary market is also known as a new issue market. It is a new issue market where the company for the first time they are going to issue their shares and securities for the general public for subscription, which are previously not available for the subscription. That is what we say primary market. So the company can raise the capital from the primary market in the form of equity shares, preference shares, debentures, loans and deposits, etc. Different avenues of funds available in a new issue market. Whatever the funds the company raised from the primary market can be utilized for the purpose of investing in any project, expansion of business, diversification of business or modernization of business. In any case they can utilize such funds. So the flotation of new issues, we have different methods, like we have 5 different methods. In that, first one is very popular one is offer through the prospects. Let me tell you first of all what is prospect. As you know that you have already know about the prospect, you have studied in your first PUC. Prospect is a like a circular, it is a notification issued by a company to the public for the subscription. So, under this method, a public limited company issues a document called prospect. They issue a document. See, here are the picture of prospect. It's look like a magazine. It's look like a small book. Okay, it is a document called a prospect which contains the detailed information about the company. This particular number of pages, whatever you are seeing here, this involves the detailed information about the company, like when the company has been started, who are the owners, okay, how many numbers of owners are there in a company, where is the registration form, which act it is following, what type of company it is, how much capital they have invested, okay, what are the interest on capital, dividend, detailed information about the company has been written, will be there in this prospect. And this prospect will be advertised in a leading newspaper as well as the magazines, which is an invitation for public to apply for the shares of a company. So it is an invitation for the public, for the general public, to apply for the shares or to subscribe the shares of a particular company. So here directly selling, there will be no intermediaries. Okay, here there will be no brokers. The company is directly appealing, directly inviting the public to subscribe the capitals, to subscribe the shares of a particular company. That is what we say offer through the prospect. Okay, so this particular prospect will have a one more blank form. If any if any general public, if any individual interested in subscription of a particular company, then he will just fill the form and along with the fees he will deposit it in a concerned bank. Okay, likewise he will become a member of that particular company. So the private company can also raise the capital. Instead of the prospect, they will issue a statement of revenue of prospect. A statement of revenue they are going to issue to the general public. So here this particular prospect will be signed by the concerned directors of a company. If any misleading informations has been there, okay, whatever the misleading or wrong information, okay, if it is mentioned in this prospect, then the directors are personally liable for the false information or misleading facts of that particular statement. That is what offered through prospect. It is one of the popular method which a companies are going to use to raise the funds from the primary market. That is what the first one. Next one is offer for sale. Offer for sale is is nothing but this particular method. The offer for the sale is, this method is adopted in case of large issue. When you want to raise the capital from the market at large scale, okay, at large abundantly you want to raise the capital from the market, then this type of these methods of flotations they are going to use. Okay, under this method securities are not issued directly to the public. Securities are not issued directly to the public but are offered for sale through the intermediaries. Okay, they are going to sell the securities, or they are going to sell the shares and bonds directly to the intermediaries. Intermediaries nothing like issuing houses. Issuing houses or stock brokers. You are going to sell your shares and securities but not directly to the general public. So under this method, this particular methods is generally follow when you want to raise large amount of capital from the market. When you want large issue, then offer for sale method is issued. Under this method, the company is not directly sell to the public but they are offer for sale through the intermediaries. With the help of brokers, with the help of issuing houses, they are going to sell their securities and raise the capital. Okay, in this company, a company sells securities at an agreed price to the brokers who are in turn resell them to the investing public. So under this method what happened, they charge the intermediaries, the brokers, they will charge higher rate than that of the price they purchase and make a profit. So they will purchase, the intermediary will purchase the shares and securities from the company at a lower rate, and the same shares and securities they will sell to the general public or investing public at a higher rate. Whatever the differences you will find, that difference is called as a profit. It is a profit for the intermediaries, it is a profit for the stock brokers. That is what offer through sale. Next one is private placement. So private placement is nothing but securities are sold by the issuing company to certain intermediaries as to be privately placed to their clients and associates. So this private, the name itself saying privately you are selling your shares and securities to those person, or for your relatives, it may be takes for your friends, you are personally selling the shares and securities and raising the capital. That is called as a private placement. See, you can see the pictures of private placement. Private placement here refers to the allotment of securities by a company to the institutional investors and some selected basis. Randomly you will select the some investors, randomly you select the institutions, okay, brokers, stock brokers, you will select it and you will sell the shares and securities. So this particular method helps to raise the capital quickly than the public issues. When you compare to the offer through prospect, offer for sale, when you compare about two methods, from this particular method you can easily raise the capital. Okay, and even there if you want to raise the capital through the prospect or through the public issue, then you have to follow number of procedures, number of mandatories and non-mandatories expenses you have to incur. But from this, if you opt private placement, such expenses can be reduced. So public companies will usually they choose for the private placement. That is what your private placement. Next one is right issue. So right issue is nothing but this is a privilege given to the existing shareholders to subscribe the new issues of a shares. So right issue is an invitation to the existing shareholders who are already the shareholders of company. For them we are giving invitation to the shareholders to subscribe the further shares to be issued by a company. If a company wants to raise the additional capital, okay, they are issuing shares additionally, then first preference, first importance will be given to the existing shareholders to subscribe such shares and securities. A right, the right simply means an option to buy certain securities. It is an option given to the existing shareholders to buy a certain number of securities at a certain privileged price. Usually the price of shares will be less when we compare to the shares which are issued in a market. When we issued in a market, usually the price of particular shares will be more, but in case of right issue, the price of a particular share will be less compared to the shares available in a market. So right here simply means option to buy a certain securities at certain privileged price within a certain specified period. For particular period, particular time duration, the existing shareholders have to purchase the shares. If not, the after the completion of certain period, say for example 1 month, 2 month, then that if existing shareholders are not interested, then that can be are listed in a stock market, that can be traded in a primary market. That is what right issue. So there will be a according to the section of 81 of a company act of 1956 has provided a pre-emission to the existing shareholders of a company to purchase the shares in further issue of a company. So even according to the company act, first and foremost preference should be given to the existing shareholders. They have to purchase the shares and shares of a new issues according to certain terms and condition. According to some conditions, they have to buy the shares of existing company. So here the shareholders are offer a right to buy a new shares in a proportion to the number of shares they already exist, they already possessed. Okay, whatever the shares they have already, according to that proportion, according to the ratio, they can purchase the further issue. That is what a right issue. So right issue is simple words we can say it is a it is an invitation to the existing shareholders to subscribe for the further share to be issued by a company. That is what right issue. Next one is EIPOS. So electronic initial public offerings, the expansion of this is electronic initial public offerings. So if any public company wants to raise the capital through online system of stock exchange, then they have to enter the agreement with the stock exchange. First they have to have an agreement with the stock exchange, then they can sell their securities, they can issue their securities to the general public through online. So it is nothing but online trading, online buying and selling of securities. So before entering to the online buying and selling online exchange, first you have to take a permission from the SEBI, then you have to have an agreement with the stock exchange, and you have to appoint the brokers, you have to appoint the merchant bankers. After all the agreements, you can go for selling of your shares and securities to the EIPOs. That is what electronic initial public offerings. That is what fifth point. So the first one is offer through prospect, or in other words we can say public issue by prospect, public issue by prospect, that we can say. Next one is offer for sale, private placement, right issue and EPOs. These are the methods or flotation of a new issue. Next one is secondary market. What is secondary market? Secondary market is a market for buying and selling of existing securities. Whatever the securities which have already traded in a stock market, that are buying and selling, that is what we say stock market, secondary market. Okay, so secondary market is also known as stock market or stock exchange. You can also refer secondary market as a stock exchange market. So it is a market for purchasing and selling of existing securities or existing shares. So this particular stock market helps to the investor to invest and disinvest the securities or shares. That is what we say secondary market. So here is the meaning of secondary market. Stock market means any body of individuals, whether incorporated or not, constitute for the purpose of assisting, regulating or controlling the business of buying and selling or dealing in a securities is called as a secondary market or stock market. So according to the Securities Contract Regulations Act of 1956, according to the Securities Contract Act of 1956, stock market they refer it is as a stock market means any body of individual, any body of individual means what? Any institutions, whether incorporated or not, which is constituted for the purpose of assisting, helping and controlling the business of buying and selling of securities. So you are going to give them regulations, okay, protective measures you are going to follow, guiding the business of buying and selling of dealings in a securities is called as a stock market or stock market. That is what secondary market. Secondary market is means what? It is a market for buying and selling of existing securities which are already traded in a market. That is what we say secondary market. We have 24 secondary markets in our country. So most properly we have NSB. You can see the pictures of secondary market, that is Bombay Stock Exchange, and NSE, National Stock Exchange. These are all the, this is the picture of both the secondary market. Okay, now let us discuss the functions of stock market. What are the functions? The secondary market will play a very important role for the development of country, for the development of our economy. So the first and foremost function, important functions which is performed by the secondary market or stock market is providing liquidity and marketability to the existing securities. So the basic functions of stock market is creation of continuous market where the securities are bought and sold. So this particular stock markets provide you a platform where you can easily buy and sell the existing securities. So here it gives the investors a chance to disinvest and reinvest the capital. So here this stock market will provide you a ready-made platform where you can either you can invest it or you can de-invest it, means you can take back your securities in the sense you can take back your capital, and if you want you can again reinvest it. That is what we say, it is provide a marketability. It give you a platform where you can buy and sell the securities. That is what marketability of existing securities. And it is also provides the liquidity. What is liquidity here? As already told you that. So here is the detailed pictures of liquidity. Liquidity means what? Any asset which can easily converted into cash without loss of time, without loss of your efforts, without loss of your money. So easily you can convert into a cash, that is called as a liquidity. So here this stock market will also provides a liquidity to our financial assets. Financial assets nothing but your shares and securities, bonds. Okay, so by through the easily marketability of securities you will also have a liquidity. When there is a easy conversion of your shares into a cash, when your securities into a cash, bonds into a cash, then that is called as a liquidity. That is what providing liquidity and marketability to the existing securities. Next one is pricing of securities. So the share price, the security price on a stock exchange can be determined by the force of demand and supply. Force of demand and supply will determines the price of a shares or price of a securities. Depends upon the marketing condition, economic condition of a market will decide the price of a shares. So the demand, okay, demand side will be the your investors from the company. There will be demand for the amount, and the suppliers are the household who save their excess amount in the form of bank, or they will invest in a stock market. They will become a supplier, sources of supplier, and the sources of demand will be from the side of companies, from the side of the firms. Okay, so based upon the demand and supply conditions, okay, based upon the demand and supply conditions will define the price of a securities. Okay, next one is safety of transaction. So the membership of stock exchange will be well regulated and its dealings are well defined according to the existing legal frame. When you are trading in a stock market, when you want to invest in a stock market, first of all, to become a member of a stock market, first of all you have to follow the number of procedures, number of cumbersome procedures you have to follow. Okay, number of legal framework you have to be adhere, then only you can become a member of a stock market. To become a broker or to become a member, then you have to get the permission from the SEBI, and the license you should be get it from the SEBI, then only you can trade in a stock market, otherwise you cannot trade in a market. So this safety of transaction will give you a guarantee. It will ensures that the investing public, whoever invest in a stock market, they will have a safety and fair dealings on a stock market. So this safety of transaction will give you a guarantee for the general public or for the investor that there will be a safety of their funds and there will be fair dealings will be there in a market. Transparency will be there in a market, that will be ensured through the through the stock market. So safety of transaction is nothing but, if you want to become a member of a stock market, first of all you have to register yourself, number of legal procedures you have to follow, number of acts, number of laws you have to follow. Otherwise your license and your memberships will be cancelled. Okay, that is what safety of transaction. When the safety of transaction is assured by the stock market or any stock market, then there will be no fear of losing the funds, there will be no fear of losing of their invested amount. That is what safety of transaction. Next one is contribute to the economic growth. This stock market will also contribute to the development and the growth of a economy. Okay, the stock market, the name itself says that stock exchange is a market where the existing securities are traded. Through this process of disinvesting and reinvesting of saved amount get channelized into a productive investment avenue. So as you know that buying and selling of existing securities, buying means what? Taking off, selling, disinvesting, that is what investing, reinvesting into a productive projects or project productive projects or productive company are using such funds for the development of a country, automatically will leads to the growth of a economy. So this investment and disinvestment will leads to the capital formation of a country. If the capital formation is there, automatically there will be a growth of a country. That is what contribution to the economic growth. So whatever the amount, whatever the buying and selling of existing securities are making, that amount will be invested in a productive purpose. Okay, you are using such funds in a developmental purpose or growth purpose, you are using such fund. From this buying and selling, investing and reinvesting, or investing and disinvesting will leads to the capital formation of company. When the capital formation of company is more, automatically there will be a economic growth. That is what contribution to the economic growth. Next one is spreading equity cult. So the stock market will also plays very vital role in ensuring wider share ownership by regulating new issues, better trading practices, and effective steps in educating the public about the investment. So this equity cult is nothing but, the publics are well aware about the shares and securities which are traded, okay, which are newly issued. So that is what wider issues of shares are being done. That is what a spread of equity. So even in a stock market you will have a scope of speculation. There will be a scope of speculation will be there. Speculations is actually illegal, but in order to give rise to the liquidity in a market, there will be a restrictive, within the legal frame they can have a speculation. The main intention of scope for speculation is to give a liquidity position in a market. That is what providing scope for speculation. These are the functions of stock market performed by the stock market as secondary market. First is providing liquidity and marketability to the existing shareholders, as the stock market will give you a ready platform where you can buy and sell the existing securities. When you are buying and selling the securities easily, okay, without consuming much time, that is leads to the liquidity of shares and securities. So any financial assets which can easily converted into cash, that is called as a liquidity. Pricing of security is nothing but, the price of a share or the price of security or bond will be decided by the marketing condition of a condition. That is what demand and supply condition will decide the pricing of a shares. Safety of transaction means what? To become a member of stock market, you have to register yourself. There will be a number of regulations, there will be a number of legal framework that have to be followed. When these are there, automatically the investors are guaranteed that their amount are safe. Okay, next one is economic growth. This also leads to the growth and development of a country through investment, through disinvestment, through reinvestment, which leads to the capital formation of country. When the capital formation of country is more, automatically there will be a growth of a nation. Next, spreading equity cult, in the sense it will give you a detail to the investors about the shares and securities and even the new issues in the market, and educating the investors about the share market and wide spread of a market. So whatever the pictures you are seeing, this is a bull and bear. The bull and bear, these are the brokers in a market, that we are not going to discuss in detail. This is not there for your syllabus. Next one is there will be a scope for the speculation. So within the provisions of law, within the legal framework, there will be a scope for the speculative activity in a restricted and controlled manner. So this is it is generally accepted that a certain degree of healthy speculation is necessary in order to ensure the liquidity, in order to give a liquidity in a market, create a liquidity in a market and the price continuity in a stock market. Little bit scope for speculation will also provided. This usually the speculation is illegal, that should not be there, but under restrictive manner, under certain legal framework, the restriction is entertained. So that the speculation is entertained. That is what providing scope for speculation. These are the functions of stock market. So if you have any doubt, you can ask me. Okay, thank you.